David George over at Baird says there is some upside out there for bank stocks following the recent rout. He upgraded his rating on Zions Bancorp to outperform from neutral and says that the current weakness in banks is, quote, beyond overdone. David joining us right now. He is Baird Senior Analyst covering U.S. banks. And David, why is it overdone?
Good afternoon, Romaine. Thanks for having me. From our perspective, the stocks are being priced for a crisis that we really don't think exists. This is really, it's maybe a crisis of confidence to some extent, but this is way overdone in our opinion. The stocks are pricing in, from our perspective, a 40 to 50% permanent impairment in profitability, and we simply think that is extremely unlikely. The returns in stocks are often a function of the price that you pay, and at these valuations, we think the current risk-reward trade-off is extremely attractive here.
Give us a sense of what you're going to be paying closest attention to as we get into the earnings season, particularly with these regional banks and super regionals, because there's a lot of talk, of course, just about deposits. But now a lot of people are also concerned about the regulatory overhang and then just the general idea of deposit rates and how they have to come up, which would compress margins.
Yeah, that's right. This clearly, Romaine, has to be the most anticipated earnings season that I can remember in the 23 years that I've done this, just given what we've been through over the last month or so. There's going to be a focus on deposits, as you said. There's going to be a focus on probably the outlook for net interest income. So given the fluidity in the deposit market and what's likely to be probably a little bit tighter credit environment as it relates to credit availability, that probably has a negative impact on loan growth this year. So would expect maybe some more cautious forward-looking commentary. But again, we think that that's more than reflected in the prices of most of these stocks.
You say that markets are pricing in permanent profitability destruction, and while that might be a little bit overdone, how much profitability destruction are we talking about? How long is this going to go on?
Well, from our perspective, Vonnie, this is something that we're maybe going to deal with for the next quarter or two. I think what we're going to find is when we go through these bank earnings, you're going to probably see that the amount of deposit movement expected is not nearly going to be as significant as what market participants are fearing. We think the vast majority of the movement in funds has been confined to the private equity part of the market, the large corporate part of the market, and from a regional perspective, California mostly, and then maybe New York and a little bit on the coast. So in large part, banking is very much a commodity business, and banks tend to price their products for a reasonable return, so a 1% or more on assets. And we think that over time, banks will have no problem returning to that level of profitability, despite the hiccups we're dealing with today.
There's lots of M&A speculation, thoughts that some regional banks might consolidate or that some of the bigger banks might buy one or two. Do we see a smaller banking sector after this, David?
Yeah, if we're starting the trend of a slow migration from smaller regional banks to larger ones from a customer flow perspective, and certainly the arguments for scale are coming into play kind of in a real-time basis, I think that you'll see more deals. It will take some time for that to develop, but we've still got over 4,000 banks, and we would expect a fairly avid M&A environment over the next couple years.